Mitch on the Markets, a conversation about the issues and trends affecting investors with Mitch Zacks, Senior Portfolio Manager at Zacks Investment Management. Mitch, you might have brought us some good news this time around. You feel we're closer to a bottom?
Well, I think we certainly are closer to the bottom. I think the Fed action that we saw today, where they left rates unchanged, but gave an indication effectively, or there are indications that they're going to make sure that AIG maintains a liquid position so that they don't have to declare bankruptcy, is very, very positive for the markets. The Lehman Brothers bankruptcy on Monday was the largest bankruptcy we've seen in the United States in its history, and it's going to take some time to go through the markets, but prior to that we were seeing very, very positive macroeconomic data. So again, if we can effectively stop the bankruptcies at Lehman Brothers with lower oil prices where they are now, you will start seeing a recovery in the economy and the market will begin to go higher. It's just very important at these stressful times not to get too emotionally involved in the market fluctuations and to realize how the equity markets end. They end several years later going higher, and you take these dips as effectively buying opportunities. If you don't let the emotion guide your investment decisions, you can be very, very profitable over time effectively.
So are we at that critical buying opportunity yet?
I think we're very close. The frenzy we saw in the market on Monday effectively when it was the largest drop in the past 6 years, and you saw the VIX hitting new highs, is a very good indication to me that now's it's much, much better to be putting money to work now, obviously, than it has been the last 6 or 7 months. And money put to work now will generate very, very nice returns over time, given that the financial crisis is stabilized. And I believe they will be able to stabilize the crisis, and that's what you're starting to see some strengthening in the market a little bit today.
So you think the Fed made the right choice by leaving rates alone?
Yes. The Fed realized that if they kept cutting rates, there's not going to be an effect. And the reason is they were cutting rates, but the overnight borrowing rates that banks were giving to each other, interbank borrowing rates, and effectively long-term mortgage rates were not being affected by the Fed cuts. And what the Fed realized is that the problem is not so much that the rates aren't low enough. The problem is that the banks and financial intermediaries are scared, and as a result of being scared, they're hoarding cash as opposed to lending to each other. And for leveraged financial institutions, that does present a problem. And the issue with the financial sector is that although the problem is in the financial sector, the equity markets, despite the sell-off that we've seen, have been holding up very, very well because the real economy, although slowing slightly, has not come to a screeching halt to the extent that was predicted earlier in the year. So given that the financial problems are resolved, oil prices are low enough now that if we get, if worst case scenario beliefs are not realized in the financial arena, you're going to see the market going higher, and I fully expect that. Just as we saw in July with Bear Stearns' essential bankruptcy, you're looking at short-term lows, and the market should be heading higher going forward. That being said, it is prudent to make sure that you are diversified in terms of cash, fixed income, and market neutral strategies. I'm not a very big believer in fixed income at this point in time because I do believe, regardless of what the Fed does, they're either going to have to print more money, and if they do, you're going to see some inflationary expectations increase, which is going to put some downward pressure on fixed income prices. So again, fixed income is rallying right now due to a fear trade, but that's not going to be sustainable over long periods of time.
Seems kind of ironic to me also that as we get these negative headlines from the financial sector, that bank stocks really aren't doing all that poorly.
Outside of the bank stocks that are really in the crosshairs, the larger banking group is actually rallying very nicely. And the reason is, if you're not the reason is, of course, because they've been beaten down so much. So because they've been beaten down so much, you're seeing some value being driven there. We're still not seeing a large number of upward earnings estimate revisions materialize in the financial service sector, and we continue to underweight the financial service sector across most of our portfolios, with the exception of maybe our dividend strategy.
One thing that I noticed is that amid all of the negative news and all of the major events that have taken place over the past few days, the dollar remains fairly stable and fairly strong.
It's similar to the reason treasuries are going up and there was downward pressure on interest rates, is because in times of stress, you don't want to be holding Russian securities. In times of stress, you don't want to be holding securities in China. You want to be holding U.S. securities, and you want to be holding U.S. dollars. So there's a flight to quality in these stressful periods, and the diversification supposed to be given from international strategies has not materialized. The diversification is there in good times, but in bad times, they get doubly hit because you have a slowing economy, you have problems on the financial service side, and then you also have a strengthening dollar due to a flight of quality. I expect that to continue, and I would not be moving back into the emerging markets or into the developed markets right now. I think U.S. equities will lead the charge going higher. I think we're close to a bottom, and I think what you continue to do in this market is you continue to dollar average into the market and put more money to work now. So now's a very good time to actually be selling fixed income securities and putting it into the equity markets and investing for a longer period of time than just a month, because right now valuations are such that you're going to make very, very nice returns in the equity markets.
Mitch Zacks, Senior Portfolio Manager at Zacks Investment Management. With Mitch, I'm Terry Ruffalo.